So I'm joined by Amanda. Amanda has had the job over the last couple of days to take the questions that you ask me on a Saturday on my Instagram Q&A and pull a couple of them, make contact with you guys, and then ask you to give them to us in an audio format. That's where we've got the questions from. Amanda's going to keep me in check. Make sure I'm actually answering the question that you asked, because these questions, it's the first time I'm getting to hear them, so I'm just going at it, okay? So let's just jump in, Amanda. Amanda, for people, just for a bit of background, works with me in Prosperous, and she is fully responsible for all the marketing that Prosperous does and some of the stuff that you see on my page as well and all across the Prosperous group.
Hi, so our question is we're currently living way beyond our means, spending all our savings and pretty much spending them on groceries. We have one income and 2 kids under 4. How should we manage our finances better or turn it around, basically?
So I think the first thing to say, one income, 2 kids under 4, maybe it's a choice one of them doesn't want to work. Maybe it's financial. Maybe it doesn't make sense for one of them to work because of the cost of childcare. What that person is describing to me there, though, is what lots of people in the country are going through. It's inflation.
Yeah.
And we have this salary. Maybe that choice was made at a time. If it is a choice that one of them works and one of them stays at home and looks after the kids, if that was a choice at the time, it made financial sense at the time. But now with the squeeze of interest rates and inflation, they're finding it's harder to get to the end of it. The big red flag for me there is that they are dipping into the savings.
Yeah.
Okay, go on.
The one good thing I would say is that they have their savings there to dip into as well, in order to, they're not dipping into or not putting something on a credit card or...
Yeah.
But they are dipping into the savings, so they need to get to a point where they're getting back on track and the savings are going up rather than down.
And one of the things we have to be very careful of here is the savings will be finite. When the savings run out, they are dipping on credit cards. They have a bit of runway at the moment, right? And if they didn't, it just sounds to me from that question that they are actually regularly dipping into savings. It's not that 1 month has hit them. It's that they're regularly dipping into their savings. And this has got the difference between cash flow and capital expenditure. And what I mean by that is your income should be able to cover your month. And when it's not, you have to dip into your savings. Your savings should be for capital events like we're doing up the house, we're going on an unexpected trip, or something that is not allowable to cover in your day-to-day expenses. And what this person really needs to address is they've got two things that they control. Or not even 2 things. They've got 2 inputs here. One is income and one is expenditure. The income is probably out of their control, but they could control it by one of them going back to work. I'm not putting that on them, and I'm not suggesting that that's what that family needs to do. But income is less so in their control. But then you're back to expenditure. And if they're right at the pin of their collar in terms of their expenditure, if they've already stripped everything back out, that's a really hard thing to do in terms of where do you look next. But what I would suggest, and we're going to talk about this at the end, I really think that person's going to get a great bit out of our conscious versus subconscious spending that I'm going to wrap the whole show up with today. And I think that person needs to hang on. I don't want to say, here's what you could have won and here's what you're going to get later. But I do think that really the expenditure is where the focus needs to go on. And that's where I think they're going to get the win. Do you think I'm being a bit harsh on them there, Amanda?
I think we could go into, if you could go into a bit more detail, I suppose, on what they could do with their expenditures. Thinking back to when we did the spring clean challenge. And it's something that they could, there's lots of different things that they could look into. Yeah. I suppose it's a short voice clip. We don't know a whole lot about this person, but we can't just think that they have gone to all their providers, say, for example, for bills.
I actually think I admire you there getting the Spring Clean Challenge in there, which was one of your most successful campaigns of the year, Amanda. Well done. For people who don't know, the Spring Clean Challenge was something we did earlier on in the year in spring,
but it was
on
great.
Instagram, and it basically took day by day, wasn't it? A week, but it was a couple of steps that we said, this is how you're going to clean out your finances.
We gave different tasks, but it is something that you could look back on, and it really took you from looking at what you're spending day to day, making you, as you said, you're going to go into the conscious versus subconscious spending, all that. But I suppose this laid out different steps for you to...
The step-by-step guide as to what to do now, what to do next, what to do next. And what I loved about that, actually, and I think why it worked so well, was because it was bite-size. We weren't asking anyone to devote a Saturday to doing this. This was a quick get in, get out, get a win, move on.
Yeah, and it was weekly as well. So it was, you look after a certain amount. If you give yourself the mountain of trying to look into everything at once, it can be very overwhelming. But if you break it down into smaller tasks, it can be a lot easier. What
I will say about that person is there's a whole pile of stuff we don't know. But what we do know is that this is not sustainable. Dipping into your savings on a regular basis is a bad sign, and they need to go and fix it.
Yeah.
Let's go with the next question.
Hi, Eoin. Where do I start to plan my finances so that I'm covered for all my normal day-to-day expenses, but I also have something there for the unexpected, so that I can try and stay away from some short-term loan for when something unexpected does come up?
This, to me, is one answer, and that's buffer.
Yeah.
Okay, so let's just explain what the buffer concept is. This person's kind of going, okay, so I'm getting along, I'm kind of getting through my month to month, but sometimes I get hit with financial surprises. Financial surprises, I would say, I'm not going to say completely non-existent, but they are actually more or less non-existent. It's not a financial surprise. It was that you weren't prepared for this financial event. Like people would say, oh, I was financially surprised I spent so much on Christmas. Christmas has happened every year of your life, right? It's not a surprise, right? Or back to school cost me this. And I'm not casting aspersions on people who can't afford back to school. I'm saying telling me it's a surprise. It's not a surprise that you went on holidays this year in July when you've gone on holidays every July for the last 10 years. That's not a surprise. So it's about being prepared. And that's what a buffer does. So the concept of a buffer is that you have a pot of money. The gold standard would be if you've got a steady income, the household income multiplied by 3. So if you're on, the house earns, let's keep it simple, €1,000 a month, you multiply that by 3, that's €3,000 a month, €3,000 in total, is sitting in your buffer, okay? If the household has a very erratic income, say it's only got one income in the household, they're self-employed, they get paid some months, they don't other months, sometimes the job doesn't pay till the following week or whatever the case is, then I would suggest it's 6 times. And people used to say to me, 6 times salary sitting, 6 months salary sitting there, just not being used just in case we have an emergency. Then COVID happened and everyone goes, 6 months salary, I get you, right? So 6 months salary. And then depending on your circumstance, you're going to be between 3 and 6. Sometimes people go, I could never save 3 months salary and just put it to one side. And then they get put off by the whole idea. For that person, just pick a random number that's achievable, like 1,000 or 1,500 euros. Just get yourself a buffer. The key and the learnings from a buffer come from the idea that, let's say you've got your buffer, the washing machine breaks down, right? Or you get you get an invoice to a wedding. Invite to a wedding, I meant, didn't I? You did that went over your head, didn't it?
It did.
So you get an invoice to a wedding. Did you get it that time? Great. Okay. So you get an invoice to a wedding and you go, I wasn't expected to be invited to that. You dip into your buffer. Okay. What you need to, and actually we'll jump away from the wedding one because that was a random one, right? But the home insurance bill comes in. Okay, it's 480 quid. You haven't prepared for it financially. You take the 480 quid out of your buffer. Financial priority number 1 after that is to get the buffer back up to where it needs to be. Okay, but the second thing you need to do is you need to set up, use like a vault or a space or a wallet or even a physical envelope if you want to go there, and put 40 quid a month into it. And in 12 months' time, when the home insurance bill comes in again for 480 quid, you're not dipping into your buffer this time. You're going for the envelope, whether that's an online one or a physical one. And you've got yourself prepared for it. That person seems like they're actually doing okay. They're just kind of getting knocked off track from time to time. And until the buffer's in place, they're going to continue to get knocked off track.
Yeah, but fair play to that person as well for recognising that they do need to get their buffer in place. And I know you have mentioned, because you did say base it on income, but you can start, because that can be, it can be quite daunting for people to think, having 3 to 6 months of my income put aside, I'm using that money all the time. And I think you've also referenced it before, trying to get the expenses is probably your expenditure
That's
in place
that's
first.
the core, yeah.
And then...
So I think if you've no buffer today, the first step is to get yourself to, let's say, €1,500, right? The next step then is to say, what's 3 times my expenses for a month? And then the next step after that is getting 3 times my salary for a month.
Yeah.
Okay. And get that into a thing. So I think that's probably a very conclusive answer for that person, because it doesn't sound like they're really struggling. They're just getting caught off guard from time to time.
Yeah. I suppose it's just really sharing how people can get their buffer in place.
Yeah.
And I suppose you could see from the first question we got in, people are struggling.
Yeah.
So
yeah.
it's quite nice to actually...
And that comes down to your controllables.
Yeah.
That's all you can do. Right, let's go for the third question. I think this is a final question, is it, Amanda?
Yes.
Hi, Eoin. Do you foresee interest rates reducing in the near future?
So we had a conversation. So this is interest rates. Do we think seeing them coming down? It's interesting. I have had a longer term opinion, or not a longer term, my opinion on long-term interest rates. And I haven't really been very public about this, but now I have the confidence to be public because Jim Power's an economist and he agrees with me. But I kind of felt that where we are now, or maybe a little bit less than this, is probably our long-term average. And I'd be happy to be a bit more public about that now in the future. And just to remind us all, he said 2.5% to 3% for ECB, and I asked him, does that really mean 4% for mortgages? And he said, yeah, more or less, right? So what I would suspect is anyone who tells you exactly what's going to happen, and I'm not casting aspersions on Jim here, but anyone who tells you exactly what's going to happen in interest rates between now and Christmas is absolutely guessing. And he would admit that too, right? They're absolutely guessing. So you don't know what's going to happen in the short term. But what we can look at is in the long term, in and around 4% for mortgages is probably right in an ordinary functioning banking environment. It's not going to go back to where it was, down to zero. And people need to get that out of their head. It's not going to go back to 2% mortgages unless we have a major financial crisis of some sort that the central banks are forced to push it down to 0%. Remember the last time we went down to 0%, it took us 15 years to get back up off it, and 0% isn't the place to be for the ECB rate.
So are you saying that 4%, not 4% of an increase from this point, that it should hover around the 4%?
Yeah. So when you're looking at mortgage interest rates, they should be in and around 4%. That means some fixed might be cheaper than that and some fixed might be more expensive. The variable might be up and down from that, but the average should be in and around 4%. But remember, that's in an ordinary functioning banking environment. We far from have that here in Ireland.
Yeah. And I suppose with you just admitting that now, so do you have any other opinions on how it will look in the next year or so for Ireland?
Yeah. So what I would say is I don't know exactly what's going to happen. My guess, and it is a big guess, is I do think, and Jim and I spoke about this earlier, I do think that we're going to level off for a while with the rate rises. And what you will find is that leveling off, then they will start to come down when they start to see inflation hitting 2% or heading towards 2%. They'll slowly come down. But I think they're going to come down very, very slowly. And I do believe the ECB will come, which affects us here, is going to come down slower. Whatever about the UK is going to come slower down than the US will. Because, again, in discussion with Jim, we have a single mandate in Europe. We have to use interest rates to get inflation to 2% and keep it there. Okay. In the US, they can use interest rates. They have a dual mandate. They can use interest rates to get inflation to 2% or whatever their target rate is. But they can also use interest rates to control or spur on the economy. So they have a dual mandate, and they can do either or. So I think they will be more aggressive and they will just do things faster than us because they're allowed to, I suppose. Whereas ours has to be based on where does the data suggest we're going to get to 2% in inflation, and they'll use interest rates to control that. But interestingly, if you do accept that 2.5% to 3% is the long-term ECB rate, add your tracker to that and see where you're going to end up. And if you accept what Jim said earlier on, that, the standard rate's going to be in and around 4%, variable rates could be very different from that. Remember, right now we have we're getting an unusual vision of what interest rates look in Ireland. The banks here have always, for the last 10 or 15 years, have been up there at the most expensive interest rates in Europe. Right now, we're third cheapest.
Yeah.
Right? So don't let that cod you into thinking, we're going to stay like this. This is the new normal. It's not the new normal. So we have to look at what our long-term history looks like to decide where long-term interest rates are going to be. What I would say to people, though, is that because we've kind of gone there with interest rates, it's what I've said time and time again. If you're deciding on a tracker, if you're deciding on a new mortgage, if you're deciding on whether you should go fixed or variable, the most important thing is sleep. You need to be able to sleep at night without your mortgage repayment coming into your head. So whatever's right for you and specific for you, get some advice and do that.
Yeah, and don't listen to everybody. I know we agreed our mortgage rate two years ago now, and at the time everyone was like, you're mad to go for a mortgage now. The house prices are so expensive. Everything is so crazy at the moment. We were told we were crazy to buy a house at that point, and our house has only gone up in value so far. I know things will take dips and everything, but it's only got harder from that point, and we were told at that point 2 years ago. So
you are mad.
Yeah.
And what I would say there is anyone, we that's again, here's the marketeer in you. We're going to do a full episode on property and property prices. So we're going to park that one just for now. But I do think, and Amanda, if you're back in with us that day, let's talk, if you don't mind, we'll talk a little bit about your experience and what that felt like when everyone was telling you were mad. But interest rates, short term, not sure where they're going, but I suspect that they'll probably go up a little bit more at some stage in the next 6 months. They'll go up. It might be immediately, it might be a little bit further on, but I think they're going to plateau for probably 12 or 15 months before we start to see them come down again. But having said that, that's what's going to happen with the ECB. We are the third cheapest in Europe at the moment, and what our banks do might be very, very different because they have a lot of meat that they could eat into to put them back at the top of the charts as the most expensive in Europe again. So that's really the questions for today. What I would say is thanks, Amanda, for coming in. We're going to make you a regular for now. You did well. You passed the test. Yeah, right. No, I don't mean that. There was never a test. That's what I mean by yeah, right. But no, thanks for coming in. And just to remind people, we will be collecting these questions. So if you don't get your question answered on a Saturday on Instagram, Amanda might be reaching out to you, asking you to give us a voice note, and we'll use it here instead.